Hello, everyone. Let's start with something very important. In the stock market, guessing rarely works. Successful traders and analysts don't rely on hope or random predictions. Instead, they follow data, analyze patterns, and track where the money is moving. Numbers don't panic, charts don't lie, and institutional capital usually leaves clues long before the public notices. Right now, those clues are pointing directly at one stock, DataVault AI, trading under the ticker symbol DVLT. Over the past 5 trading sessions, something remarkable has happened. Almost everything that analysts predicted for this stock unfolded with incredible precision. The price movement followed the technical roadmap almost step by step, and if you were watching closely, you may have seen one of the cleanest setups in the market so far this year. So the big question many investors are asking right now is simple. Is DVLT still a buy at these levels? Are the major institutions still quietly accumulating shares, while retail traders panic and sell? And could the extremely high short interest in this stock eventually trigger a powerful short squeeze? In this video, we are going to break everything down in detail. By the time we reach the end, you will understand the technical levels traders are watching next week, the potential entry zones that analysts believe are most important, who is buying behind the scenes, and the 2 major catalysts that could push this stock significantly higher before most investors even realize what's happening. To understand the current situation, we need to rewind a little. Several days ago, analysts outlined a very specific scenario for DVLT. The idea was that the stock was approaching a maximum pain area, a point where fear and negative sentiment had pushed the price far below what many believed was its actual value. To most traders looking at the chart, DVLT looked like a falling knife. The price had dropped sharply and the trend looked weak. But when analysts examined the technical structure more closely, they saw something different. They saw a tightly compressed spring necklace, a stock that had been pushed down aggressively, but was sitting on a support zone where larger buyers could begin building positions. This type of setup requires patience and conviction. You have to ignore the noise, ignore the headlines, and focus on the structure of the market itself. And that structure predicted something very specific at Groin. If the stock broke below 74 cents, the next support level was expected around 67 cents. That zone was identified as a potential entry area where buyers could step in. Now here's where things get interesting. On Monday, March 2nd, DVLT dropped to an intraday low of 64 cents. The following day, Tuesday, the stock printed a low of 65 cents. Those numbers landed almost perfectly inside the predicted entry zone. This wasn't luck. It wasn't a random guess. It was the technical framework playing out exactly the way it was mapped in advance, and what happened next was dramatic because of it. After touching those lows, the stock rebounded sharply throughout the week. By Thursday, DVLT had climbed all the way up to 79 cents. That represents roughly a 23% move upward in just a few trading sessions. For traders who followed the plan, stayed patient, and trusted the levels, it turned into one of the most clearly defined opportunities of the year so far. However, the rally ran into a problem at a level that analysts had also warned about ahead of time: 80 cents. This level isn't just another number on the chart. In technical trading, certain price levels become psychological barriers. They attract large clusters of sell orders and act as resistance zones where upward momentum can suddenly stall. 80 cents has been exactly that type of level for DVLT. When the stock reached 79 cents on Thursday, sellers stepped in aggressively, preventing the price from breaking through that barrier. And this brings us to one of the most important technical points to watch. If DVLT can reclaim 80 cents and hold it as support instead of resistance, the entire technical outlook changes. Instead of a simple recovery from oversold conditions, the stock could transition into a genuine breakout phase. That type of shift often attracts new buyers, momentum traders, and algorithmic trading systems. But if everything was looking so positive technically, why did the stock fall back down to around 69 cents by the end of the week? The answer has less to do with the company itself and more to do with what happened in the broader global markets. On Friday, investors across the world suddenly shifted into what traders call a risk-off mindset. Geopolitical tensions escalated, energy markets reacted violently, and Brent crude oil surged dramatically, jumping toward $90 per barrel. When events like this occur, investors often sell speculative assets first. Growth stocks, small-cap companies, and especially sub-dollar stocks tend to get hit hardest during moments of global uncertainty. Retail traders frequently react emotionally during these periods, selling positions quickly to reduce perceived risk. But here's the key question many analysts are asking. While retail investors were panic selling, were the large institutions doing the same thing? The ownership data suggests the answer is no. In fact, some of the largest asset managers in the world appear to have been increasing their exposure to DVLT. BlackRock reportedly expanded its position in the company dramatically. Vanguard also increased its holdings significantly, and State Street showed similar behavior. These are not small hedge funds chasing quick trades. These firms manage trillions of dollars and employ entire teams of analysts who evaluate companies in extraordinary detail. When institutions of this size increase their positions by thousands of % over a short period, it rarely happens randomly. Another interesting data point comes from the relationship between price action and institutional ownership. Over the last 90 days, the stock price declined roughly 64%. At the same time, institutional ownership increased by more than 40%. In other words, while the price was falling, larger investors were quietly accumulating shares. This type of divergence is often interpreted as a sign of long-term accumulation. It suggests that experienced investors may view the lower prices as an opportunity rather than a warning sign. Currently, more than 80 institutional entities reportedly hold positions in DVLT. That doesn't automatically guarantee success, but it does highlight a significant level of professional interest. Now let's talk about valuation. Some analysts covering the stock have issued price targets that appear extremely ambitious compared to its current trading level. The average target among certain analysts sits slightly above $4 per share. That represents a potential increase of several 100% from current prices. One firm, Maxim Group, has reportedly maintained a buy rating with a similar target. Models that estimate intrinsic value based on revenue projections have also produced numbers in that general range. But where do those calculations come from? One explanation involves the company's projected revenue and how it compares to similar companies in the artificial intelligence sector. DVLT's market capitalization is currently around $400 million. Management has indicated revenue guidance that could approach $200 million in 2026. That implies a forward price-to-sales ratio of roughly 2 times. Many AI-focused companies trade at multiples significantly higher than that, often between 8 and 15 times revenue. If DVLT were valued even at the lower end of that range, the share price would theoretically be several times higher. However, valuation models only matter if the company is actually building something valuable. According to company announcements, DVLT has been working on partnerships and projects that revolve around data monetization and blockchain-based infrastructure. This includes collaborations involving well-known brands, media platforms, and sports organizations. Additionally, the company has discussed initiatives related to tokenizing real-world assets such as commodities and environmental credits. These types of markets could potentially be extremely large, although they are still developing. Beyond partnerships and valuation discussions, there are also 2 major catalysts that traders believe could influence the stock's movement in the near future. The first involves the company's broader expansion into blockchain-driven asset tokenization. The second involves a compliance requirement tied to its listing on the NASDAQ exchange. In order to remain listed, the stock must eventually regain a minimum bid price of $1. The deadline for meeting that requirement is August 24, 2026. This situation creates pressure for management to take actions that could support the stock price, such as announcing partnerships, improving financial performance, or implementing strategic corporate moves. On top of all of this, there is another factor that traders are watching closely: short interest. Approximately 26% of the stock's float has been sold short. That means tens of millions of shares have been borrowed and sold by traders betting that the price will fall. If the stock suddenly begins moving upward quickly, those short sellers may be forced to buy back shares in order to close their positions. That process can create what's known as a short squeeze, a rapid upward move driven by forced buying. Borrowing costs for short positions have reportedly risen sharply as well, making it increasingly expensive for traders to maintain those bets. When you combine high short interest, institutional accumulation, and potential catalysts, the situation becomes very interesting from a market dynamics perspective. However, it's extremely important to remember something. Stocks trading under $1 are inherently risky. They can be volatile, unpredictable, and subject to rapid changes in sentiment. Nothing discussed in this video should be considered financial advice. Always conduct your own research, evaluate your personal risk tolerance carefully, and never invest money you cannot afford to lose. Looking ahead to the upcoming trading week, analysts are focusing on several key levels. The primary support zone appears to sit between 67 and 70 cents. That area has previously attracted buyers and could act as a floor again if the price revisits it for it. Below that level, the panic low near 64 cents represents a worst-case support level. On the upside, reclaiming the 79 to 80 cent area remains the most important technical objective. If that barrier breaks with strong trading volume, the next potential target could move toward the high 80-cent range. Beyond that, the psychological $1 level becomes extremely significant because of the NASDAQ compliance requirement. So where does that leave us? Dvlt currently represents a fascinating combination of technical structure, institutional interest, and market speculation. If the support levels hold and the company delivers positive developments, the upside potential could be substantial. But like all speculative investments, the risks remain real and significant. In the end, the market will decide. The data is there. The levels are clear. Now the only question is what happens next.